Hello friends, a very warm welcome to my channel. In this video, we are going to talk about Fiem Industries, which is one of the leading auto ancillary players in India. And this company is not much discussed when it comes to the EV theme, but silently this company is going to be one of the leaders in the auto ancillary space in the EV segment in India. In EV segment, as you know, the adoption will be faster in the two-wheeler segment, and this company already supplies to all the major OEMs who are manufacturing electric vehicles in the two-wheeler segments. So it's going to be very interesting to watch till the end. Before we begin, if you're new to the channel, please do subscribe and hit the bell icon, and you can join our Telegram channel where we discuss daily market analysis and lots of interesting news and views. So let's get started. So Fiem Industries is one of the leader in the two-wheelers lighting solutions in India. It is one of the leaders in the signaling equipments and rear view mirrors in India. It has more than 30% market share when it comes to the two-wheeler headlamps market in India. And recently it has also ventured into the LED segment. LED lights manufacturing related to the automobiles industry as well as the other regular LED lights which we use indoors and outdoors. This company was incorporated in 1989 by Mr. J.K. Jain, and his further successors have also joined the business. This company has 9 manufacturing facilities located across India, and they also have their exclusive research and development centers in India, Japan and Italy. Before talking about the company, let's talk about the auto ancillary industry in brief. So auto ancillary industry majorly consists of broadly these divisions which are related to lighting and signaling, engine parts like pistons, rings, etc., electrical parts like starter motors, generators, driving transmission parts, suspensions and braking parts, and the other parts like the rear view mirrors and wiping systems. So this company is mainly into the lighting and signaling equipment. In the last few years, if you observe, the auto ancillary industry or the auto industry itself is witnessing a kind of a downturn or a slowdown. In FY 15-16, the total number of vehicles manufactured in India were about 23,961,000. These numbers are in thousands. And this went up to about 25,313 in 2016-17. So this trend continued up to FY19, which is about 30,914. But from FY20 and 21 onwards, there has been a reduction in the total number of vehicles manufactured across all the categories. If you observe, passenger vehicles, commercial vehicles, three-wheelers, as well as the two-wheelers industry. So this downturn is due to several reasons like the COVID disruptions, the semiconductor shortages, and various other reasons as well. So unless these things are sorted out, this industry is going to witness some headwinds, and the performances will not be up to the mark as in the earlier years. So in FY21, the industry is at a 6-year low, and the Indian auto ancillary industry contributes about 2 to 3% in the total India's GDP. The automobile component industry is expected to reach a revenue of about $200 billion by FY26. So the growth potential in the industry is quite good, but on a temporary basis, it is witnessing a slowdown. And just the exports from this entire share are expected to reach about $80 billion by FY26. If you specifically talk about the automobile LED market, it is expected to grow at a CAGR of close to 6%, and this will reach about $4.15 billion by FY27. As of now, the industry is witnessing problems such as the logistics issues globally, the disruption in the supply of semiconductors, as well as the inflationary pressures which are creating a lot of pressure on the margins of various companies. Post-COVID, there has been a lot of interest by different people in having their own personal vehicles, which is generating tailwinds for this industry. From the government side also, there are several initiatives like the Make in India movement, the vehicle scrappage policy, movement towards BS6, the electric vehicles importance. So all these kind of things are also generating tailwinds for this industry. So there are short-term headwinds, but in the long term, the industry outlook seems positive. Now let's talk about the management of the company. The managing director and chairman is Mr. J.K. Jain, who has about 4 decades of experience in this industry. He manages the entire company overall and handles the growth and strategy of the company. His successor, his son and daughters have also joined the company, and they are playing key roles in the management of the company. He's a first generation entrepreneur, and he's one of the pioneers in the automotive industries in India. Now let's talk about the brief history of this company. It started in 1989, and originally the name was Rahul Auto Private Limited. Later in 1992, the name was changed to Fiem Industries Private Limited, and in 1993, it got converted into a public limited company. In 1994, there was the first unit which was set up in Sonepat. In 1996, there was joint venture company established with a technical collaboration with a foreign company which is Fiem Sand Limited. You will observe during the analysis that the company has done several technical collaborations with foreign companies like in Japan and Italy, using whose technology the company is developing extraordinary products. During the period from 2004 to 2006, they have set up 5 manufacturing units which were followed by the original unit as we have discussed. And in 2006, they came up with their IPO. In 2007, they ventured into the LED business and started their LED SMT plant. In 2010, they started their 7th unit of manufacturing in Sonepat. In 2011, they set up their 8th unit of manufacturing of plastic molded parts. In 2015, they started receiving tenders for manufacturing their electrical LED bulbs. In 2016, they started their Unit 9 in Ahmedabad, and in 2017, they started a manufacturing plant for manufacturing canisters in collaboration with again a foreign Japanese company. In 2017, they entered into a joint venture partnership, a 50-50 partnership with a company based in Hong Kong. In 2018, they entered into another joint venture with a company called ASEAN Industry Company, which is again a Japanese company to manufacture fuel pumps. In 2019, they set up a design center in Italy, and they also started their R&D center there. In 2021 onwards, they started getting their EV clients, and Ola Electric is also their client. Now let's talk about the business model of this company. Mainly there are three divisions in their business. The first one is the automotive division. In automotive, again there are four sub-segments, which is the automotive lamps and LED automotive lamps, the rear view mirrors and the other parts. Apart from the automotive business, there is LED luminaries business, which is related to the LED lamps. In that they have indoor lighting as well as outdoor lighting. Other than this, they have IPIS division, which is about passenger communication systems. We'll discuss in the coming slides. It is again for buses as well as the railways. So broadly, there are these segments in their business. Now let's talk about them in detail. In the automotive lamps business, they have LED as well as the regular halogen lamps. They manufacture headlamps, tail lamps, blinker lamps, fog lamps and various other lights which are used in the automotives. The same are manufactured both in the regular lamps as well as the LED lamps. For the last 5 years, if you see the revenues from their automotive lighting segment is somewhere stagnant. They are not witnessing much growth in the last couple of years. In the rear view mirrors, they manufacture the mirror plates, they manufacture the plastic housing and the rods. The rear view mirrors revenue is also hovering somewhere around 150 crores in the last 5 years. In the plastic molded part segment, they manufacture parts like fender fairer, floor panels, side cover, rear fenders, etc. The plastic molded parts revenue is also remaining range bound in the last 5 years and hovering somewhere around 100 to 150 crores. Other than the plastic molded parts, they also manufacture canisters, sheet metal plates as well as bank angle sensors. The manufacturing from the other subparts is gradually increasing from about 42 crores in FY17 to about 137 crores in FY21, as they are concentrating more and developing more parts other than their lighting segment. Coming to the other segments, which is other than the automobile division, they have indoor lightings. In indoor lightings, they manufacture bulbs, tube lights, down lights, panel lights. In outdoor lighting, they manufacture street lights, floodlights, like all the other outdoor lights which we use in our daily life. In the IPIS division, which is the Integrated Passenger Information System, these are the display units which you see, which display the messages which we generally read in the buses, trains and the stations. So they manufacture these display units for buses as well as for the railway. Now let's understand the share of revenue. From their LED segment, they get about 0.6% of their revenue, and maximum revenue they get is from their auto segment, which is about 99.4%. If you compare the segment wise revenue, from the automotive lamps, which is the non-LED, they get about 38%. From LED lamps, they get about 28%. Plastic molded parts, they get about 11%. Rear view mirrors is also around 11%, and all the other parts somewhere around 11.24%. So of their sales to specific categories of customers, they generate about 90% of their revenue by supplying these parts to the OEMs, which are the original equipment manufacturers, which are the brands from which we buy our automobiles. They get about 7% of the revenue from replacement market, which is after sales. Whenever there is a problem in the automobile, we replace those spare parts. So that replacement market, they get about 7%, and exports contribute somewhere around 4% of their total revenue. In terms of two-wheeler and four-wheeler division, a majority of the revenue, close to about 96%, is generated from the two-wheelers, and four-wheelers contribute only about 4.5% until now. Now let's see the customers. Starting with the two-wheeler division, which is the domestic customers, you can see all the popular brands, and they work as suppliers to all the major brands in India like Honda, TVS, Suzuki, Yamaha. In the two-wheeler, which is the global customer base, they also work with brands like Honda, Harley Davidson, TVS, Suzuki. In the four-wheeler segment, they work with domestic brands like Tata, Maruti, Skoda, Hyundai, Honda. So they work with all the major brands in the domestic segments, which is the four-wheelers. As a global four-wheelers, you see they work with Kubota, Komatsu, SpareX. Coming to the LED customers, they work with various companies like Honda, Suzuki, Bikanerwala, Samsung. Now let's do a competitor analysis. The major competition of this company is from companies like Motherson Sumi, Minda Industries, Sandhar Technologies, Lumax Auto and Varroc Engineering. In terms of market cap, if you see, this company is somewhere around 1250 crores. Motherson Sumi and Minda Industries are much bigger companies than Fiem Industries, whereas Sandhar Technologies, Lumax and Varroc Engineering are somewhere comparable. In terms of revenue also, Fiem Industries generates about 1500 crores of revenue, whereas Motherson Sumi and Minda generate much higher. And Varroc Engineering generates close to about 12,000 crores of revenue. So in terms of revenue, this is comparable to Sandhar Industries as Lumax Auto. The entire auto ancillary industry does not generate much attractive EBITDA margins, and they generate somewhere around 8 to 12%. If you also see the return on capital employed, this industry doesn't generate more than 20% ROC. Their ROC generally is either in the single digits or up to about 15%. So Fiem Industries generates about 12% EBITDA margin and about 12% ROC, which compared to the other industries may seem lower, but within the industry it is quite decent. If we compare the price to earning ratio, it's about 14 for Fiem Industries, which is similar to other companies like Sandhar Technologies as well as Lumax Auto, whereas the other bigger companies like Motherson Sumi and Minda Industries have higher Ps, which are about 40 to 80 Ps. So when we compare this to the other companies in the same segment of a similar size, in terms of margin ratios as well as return ratios, the company is doing well, and in terms of valuations also it seems reasonable. Now let's talk about the competitive strengths or economic moat of this company. They have market leadership in two-wheeler lighting segment, as we have discussed. They have more than 30% market share in that segment. They have set up their own research and development center to develop latest products for their customers. They have long-term relationships with more than 50 OEMs, and generally in this industry the customers' stickiness is very high. They don't change their suppliers too often. So this company gets continuous orders from all these customers across the period of time. The management is quite experienced. They have close to about 4 decades of experience in this industry, and this is a well-known supplier to global customers and generally their preferred supplier. The company has good manufacturing facilities right from research, design till the delivery of the product. So they reduce the development cycle and delivery cycle of the product to their customers, so their deliveries are faster and as per their customer requirements. In terms of cost, also their manufacturing cost is quite economical when compared to their competitors. They have diversified products across the two-wheelers as well as the four-wheeler segments, and now they are diversifying into segments other than the automobiles also. Their plants are located across India, so they can service their clients quickly. And if some client comes up with a bigger requirement and a continuous demand, the company is flexible enough to set up a individual manufacturing facility close to their client's manufacturing factory. The company has done a lot of technical collaborations with foreign companies so that they get latest technology support from them, and their manufacturing is done in India itself. Let us talk about the electric vehicles theme in India and how is Fiem Industries playing or going to play a key role in this sector. So as of now, in the regular engine space also, the company has market leadership and close to about 30% market share. Coming to the EV segment, they are already working with all the major electronic vehicle brands in two-wheelers, like they are already working with Ola Electric, Polarity, Bounce, Revolt, Okinawa, Torque, Ampere, Hero Electric. So you can see that all the major brands in the two-wheeler EV segment are already working with them. And generally in this industry, they don't change their suppliers often and they remain close to their existing suppliers itself. So it is not easy for a new entrant to come and replace Fiem Industry as a supplier to this electric two-wheeler manufacturing companies. So now when the EV segment grows bigger in India, the OEMs start manufacturing and selling large number of vehicles, the market share in the EV segments will be much higher than the 30% in the non-EV segment. So this is what the company is saying. When the electric vehicles become more popular in India, this company will remain a market leader in supplying them lighting spare parts, but their market share will be much higher than 30%, which is existing in the non-EV segment presently. And as you know, the electric vehicles adoptions in two-wheelers is much faster than the four-wheelers in India. The government of India has also increased the FAME 2 subsidy from 800 crores to 3000 crores, which will help in faster adoption of EV segment in India. This company is a sole supplier to the Ola Electric for headlamps, tail lamps, indicators, rear fenders. So a majority of the parts which Ola Electric require relating to the lighting are being supplied by Fiem Industries itself. In this way, the investment in this company is an indirect play across the EV sector in India. Now let's talk about the highlights of the recent earnings call which the management did, they said that the industry is facing headwinds due to shortages of semiconductors, and this is going to continue in the near period of time. The company has become a debt-free company and they plan to do a capex of about 70 to 100 crores in the next 2 to 3 years. They are getting more orders and more OEMs are shifting to the LED lights, so their revenue from LED lights will increase from presently 40% of their total revenue to about 60% in the next couple of years. From FY23, the company is expecting much higher demand from the EV segment, and they have also exited one of their joint ventures recently with Fiem Automotives, for which they will be getting back their 26 crores which they had invested earlier. Now, what are the growth prospects of this company in the near future? As we have discussed, the company has capex plan of about 75 to 100 crores in the next 2 years. So they are witnessing some trends in their industry. The OEMs are slowly moving towards the LED lamps from their normal lamps. The shift of EV is getting quite faster when compared to the earlier years. And Fiem Industry is the preferred supplier for both these categories. So when the demand in both these categories increase, Fiem Industry will be able to generate higher revenue because these products are higher ticket value products, higher margin products, and these products require better technology of manufacturing which Fiem Industry already has. So these trends will in turn help in faster growth of Fiem Industries. In this chart, you can see from FY19 to FY24, which is estimated, gradually the share of LED lamps is going to increase from about 33% to about 52% in the next few years. What are the risks which this company might face? The company generates majority of revenue, close to 95% of their revenue from two-wheeler segment. So there's kind of a concentration of revenue, and any slowdown in demand from this segment will affect the company's performance drastically. This industry is a bit of cyclical industry. So if the industry enter into a slowdown or consolidation phase, it goes on for about 2 to 4 years. Presently, the chip shortage is creating a lot of issue in this industry, and such kind of risks may reoccur in future also. They have to be updated with latest technology which the OEMs expect them to manufacture. Otherwise, the OEMs may change their supplier. And this company's sales are dependent on how their OEMs perform. If the OEMs perform well, then the demand is good for the products of this company. If the OEMs underperform, then the demand for their products also will get reduced. The inflationary situation which is at present is also creating a lot of pressure on the margins of the company. Let's talk about the numbers. Starting with the quarterly result, they've got about 389 crores in Q3 FY22 compared to 358 crores in revenue. EBITDA went up from 42 to 47 crores, profit after tax from 20 to 23 crores. EBITDA margin is close to about 12% and profit after tax margin is somewhere around 6%. In terms of revenue, EBITDA and profit, they have done better than the last years, and margins are maintained well in spite of the inflationary pressure. The last 5 years revenue is more or less range bound, ranging between about 1200 crores to about 1500 crores. And after the present issues in the sector are sorted, the company expects this revenue to be much higher. The EBITDA is also ranging between about 140 to 180 crores in the last 5 years. EBITDA margin is constant, somewhere around 11 to 12%. Profit after tax has shown a decent increase from about 53 crores in FY18 to about 88 crores in the trailing 12 months. Profit after tax margin has slightly improved from about 4% in FY18 to about 5.85% in the trailing 12 months. Equity is constant. The reserves are steadily growing as it's a continuously profit-making company. The borrowings have decreased and now the company is a debt-free company. The trade payables are normal. There are no abnormal movements in trade payables. The fixed assets are steady, somewhere around 550 crores. The inventory is decently maintained. There are no abnormal spikes in the inventory levels. The trade receivables have reduced, in fact, from about 150 crores to about 75 crores in September 21. So reduction of trade receivables is a good sign. The debtor days also have gone down from about 40 days to about 24 days in the year FY21, which is also a good sign. Inventory days are also slightly reduced from about 70 days in FY18 to about 57 days in FY21, which is again a good sign. ROC is not much impressive. It has taken a dip to about 12% in FY21. Liquidity wise, the company is doing decent. They have about 100 crores of cash on FY21, but this has reduced to about 30 crores in September 21. The operating cash flows have always been positive. They did about 130 crores of operating cash flows in FY21. Free cash flows were only negative in FY17, but thereafter the free cash flow has always been positive, and they generated about 116 crores of free cash flows in FY21. The ROE is about 9%. The dividend yield is close to 1.68%, so it's a dividend paying company. The remuneration to executive directors is about 4.39 crores, which is well within the limits, and the auditors of the company are Sachdeva and Associates. In the related party transactions, there are no material adverse related party transactions which could cause any risk to the company. Let's talk about the shareholding pattern. The promoters hold about 66.5% stake. The FIIs hold about 10.5% and DII is about 0.2%. The public holds about 22.8% share. Now let's talk about the valuations. As we have seen in the competitors analysis, in the same segment, in the similar size of companies, the valuations seem reasonable. The last traded price is about 950. The 52-week high and low is 1378 to 525. In the last 1 year, the stock has generated a return about 72%. Last 3 years, CAGR is 25 and last 5 years is 2%. Now, you observe a peculiar thing. In the last couple of years or 3 years, the stock is showing decent return, but last 5 years only 2% CAGR. This is because it is the cyclical nature industry. So in auto, you have to kind of time your entry and exit to maximize your gains. The median PE is somewhere around 17 in the last 5 years. Market cap is 1250 crores. The face value is 10 and the EPS is around 67 rupees. So taking this trailing 12 months PE comes to about 14. The industry PE ranges between 15 to 17. So in terms of price to earning ratio, it's quite decent. Book value is 445, which makes the PB ratio 2.13. So in terms of book value also, valuation seems reasonable. Market cap to sales is 0.83. So in terms of market cap to sales also, the valuation appears to be reasonable. But one thing you should remember that this is a cyclical industry, and if the performance of the company goes for a toss, then all these ratios will drastically change in just 1 to 2 quarters. Now let's look at the chart. The stock is taking support constantly around 950 range. So if you are comfortable and if you feel that the industry will do well from the present quarter, then you can make an entry at somewhere around 950 and gradually accumulate. Or if you are quite doubtful of the performance of the industry, then you can wait for further correction and get into the stock at maybe 100 or 150 rupees lower and then accumulate for the industry to do well in the near future. So this is about Fiem Industries. We have talked about the company, the business, the EV sector, as well as the numbers. I hope you've got a complete idea about the company and the sector we are talking about. So overall, to summarize, the management is good in the company. They have quite well experienced. The company has market leadership in the products which it manufactures. The trend is moving towards LED and electric vehicles, in which the company is going to be one of the leaders. The company has global presence and they have a lot of scope to expand their presence in various other countries, being in India, and be a low cost product provider. They have strong research and development facilities as well as manufacturing facilities. Fundamentally, the stock is decent, but we can't expect this industry stock to have much higher margins and return ratios as the other industries or service industries. Customer stickiness will generate regular revenue for companies like this. It's a debt-free company, but the industry is cyclical, so you have to make an entry and exit at the right time, or at least you have to do a partial profit booking in cyclical industries. One thing we have to closely monitor is the consistency in the performance when you are invested in this company. Otherwise, if there is a slowdown in the industry or the company's performance, you have to take an exit. Presently, the sector is facing a lot of headwinds due to supply disruptions as well as the shortage of semiconductors and logistics issues. In terms of valuation, the stock seems reasonably valued at the present financial performance. If the financial performance deteriorates due to any reason, then the valuations might drastically change. So keep these points in the mind and take a wise decision of investing in the company. So this is about Fiem Industries. I hope you like the analysis. If you like it, hit the like button. If you want me to analyze your favorite companies, don't forget to name those companies in the comments below. I will surely consider them for my upcoming videos. So thank you for watching and have a wonderful day.